Many of us have stayed in enough hotels to think we understand the business. You look at the occupancy rates, calculate the nightly room prices, and conclude that a 100-room property is a sound investment. The global scale is undeniable. Around 700,000 hotels generate over $1.5 trillion in revenue every year, making hospitality one of the most consistent industries on the planet. However, the people who put up the money to build these landmarks often own far less than the signage suggests. Hilton, for example, owns only 3% of the 9,000 properties carrying its name. The remaining 97% are owned by private investors, developers, and real estate funds. These private owners take on the total financial risk of construction and staffing, yet they surrender the daily control of the business to the brand in exchange for the name on the marquee. Building a mid-range 100-room hotel in an average U.S. city requires an initial $15 to $22 million. Purchasing an existing 250-room property near a major hub can cost upwards of $60 million before a single light bulb is changed. Ownership immediately triggers a mandate from the brand called a Property Improvement Plan, or PIP. This plan is a required list of renovations to meet current brand standards. For a mid-scale property, these forced upgrades to lobbies, carpets, and internal systems can cost several $million. If you refuse the renovations, the brand removes the flag. Without that brand connection, the hotel loses access to the global reservation system, which significantly reduces the property's occupancy and market valuation. This means an owner often spends millions catering to the brand's aesthetic requirements before the first guest even checks in. Once the renovations are complete and the hotel is operational, imagine it generates $5 million in annual room revenue. The brand takes its cut immediately. Royalty and marketing fees consume roughly 10% of gross revenue. Next, professional management companies run daily operations, taking another 3% to 5%. Finally, online travel agencies like Booking.com carve out 15% to 30% commissions on reservations they facilitate. Brands fight these commissions with loyalty programs, but those members have costs. Owners must fund the points and redemptions that further thin the margins. Operating costs remain high, with labor typically accounting for 34% of revenue. In 2024, insurance costs for hotel owners rose 17% in a single year. After every party takes their share, the average U.S. hotel is left with a net profit margin between 8% and 10%. On a $5 million revenue stream, that leaves the owner with about $450,000. At that rate, it takes 30 years of perfect operations just to earn back a $15 million initial investment. Marriott International recently reported $5.4 billion in annual gross fee revenues. This is the money collected from property owners for the use of the brand name, regardless of whether those individual hotels are profitable. This is the asset-light model. The brand avoids the costs of owning real estate, maintaining roofs, or fixing elevators. They own the reservation technology, the loyalty data, and the standards manuals dictating every detail of the guest experience. The brand's percentage is guaranteed, even during economic downturns. If the roof leaks or a recession hits, the financial burden rests entirely on the property owner. This dynamic is reflected in the market. Over the last decade, an investment in Hilton stock would yield higher returns with far less effort than the daily grind of operating a single Hampton Inn. Mega brands have created a system that captures the financial upside of the industry while offloading the operational friction to their franchisees. If the margins are so tight, how are people making real money in this business? Success in the U.S. hotel industry has been driven largely by a specific strategy used by Gujarati Indian American families, who now own roughly 60% of all economy and mid-scale hotels in the country. They started by purchasing independent motels and living on site. By using family labor instead of outside staff and avoiding management fees, they protected the margins that usually disappear into other hands. They reinvested those profits into more properties, eventually adding brand flags to access global reservation systems while maintaining their lean, family-run operational model. These owners treat the corporate brands as distribution tools to fill rooms, rather than relying on them to manage the business, allowing them to scale into vertically integrated empires. For the average investor with a single $15 million Hampton Inn, the best-case scenario is a modest annual cash flow after all debts are serviced. That progress is regularly interrupted every 7 to 10 years when the brand mandates another multi-million-dollar renovation plan. This creates a cycle where the owner manages the debt and repairs, while the brand reports record fee revenues and consistent growth. Physical structures have become low-margin commodities. The real value in hospitality has shifted away from the concrete and toward the digital network. In the modern hospitality economy, the highest returns are found in the customer data, the proprietary booking systems, and the brand on the app.